you brought up a number of points. Now, I don't know if you had anything in particular that you wanted to address, that of David. I have a number of points here.
I just might say, I think that the a fundamental thing is that shareholders can fix it. I don't think activism is all bad. I think that many of the activist situations actually are course corrections. And to the extent that we have completely dual class stock companies, that's stopped cold. And I think that's actually a problem. I would say I think that the number of companies going public in the United States, at least, that are dual class goes up and down. It's not been as great as some people in Silicon Valley say it's going to be. I keep getting told it's going to be all the companies, and then it's not. Yeah. And a fair number of them do have sunsets on them, 30% of the ones that do adopt dual class structures. So I'm not convinced. It seems to have bounced around year to year. I also don't know that we know what the result of the WeWork debacle quite is yet. That seems to have affected, just from investment bankers approaching us, and including one who was involved with WeWork and said, you guys need to put your foot down and not accept this kind of structure. Investment bankers are weak, he said. You guys got to do it. So, which I'm sure is true on the first part. I'm not sure how we do it exactly. But, and one interesting footnote, so I think it has, it does have to do with bargaining power of founders, and particularly like in the Snap situation, really the whole thing was a bet on the two founders. There's huge speculative variation in value depending on how it panned out. And if the two co-founders had died the day after they went public, it would have been a disaster. It was riding on them. What's interesting, at least in the United States, and I'm overly familiar with the United States, sorry to be too narrow on focus, but biotech companies very seldom go public with dual class. So those are the riskiest investments, and we get a steady stream of biotech companies. So why is that? My theory is that it's because the value is not all impounded in the founders. They have scientific processes that they're going through. They're documented. They actually have a product in development and may bomb and not get permission to be sold. But very seldom do you see dual class at biotech companies. So I think that may be a bargaining question. There also is thought to be a discount attached with going public with dual class for most companies. So I think that's a little bit of a break. Now, you can get into different arguments about how much of a discount is attached. Anyway, I just throw that in there. I would want to say I don't think there's anything particularly wrong with private equity. I think there are advantages and disadvantages to public equity and private equity. Now, I may be biased. Our core members do a lot of private equity investments. They're very successful with it. And I don't really think dividing the world that way is a particular problem. And on the lower number of publicly listed companies, it has to do as much with concentration and lack of antitrust, because the market cap's actually much larger. Was at a record a couple days ago.
Yeah, we fixed that.
Right. So we've seen just tremendous concentration, and which I think is a whole different kind of issue.
Well, Andrew Hill of the Financial Times, he wrote, "The advantage of dual-class shares is that it protects entrepreneurial management from the demands of ordinary shareholders. The disadvantage of dual-class shares is that it protects entrepreneurial management from the demands of ordinary shareholders." 6 of one, half a dozen of the other. The actual numbers on tech IPO dual class in terms of percentage in the last 5 years is 37, 24, 43, 33, 38. So they're not increasing, but those are large percentages of the tech IPOs. That's from Jay Ritter.
Jay Ritter. So yeah. Jay Ritter, he's great, but I would fault his. So he's including in that a number of companies that are technically dual class, but actually have equal voting rights. Including some various structures. I think it's an exaggerated number.
You do?
Yeah.
Oh, okay. Well, that's interesting. Well, I say at the end, I don't think the potential for abuse exists in both classes of shares. And I've listed the ones in the single class of share companies that have been catastrophes. And we can list others like Conrad Black and abuse of power by that fellow who ran Magna. What was his name? Frank somebody or other? Yeah. But there are also workarounds. If you go to Prem Watsa, Fairfax. And by the way, Prem brought Cara public, which was a dual-class share company bringing another dual-class share company public, oversubscribed in this market, maybe we're dumb, by 20 times. There was no discount whatsoever in that public issue. Prem limits his salary to $125,000 a year in the bylaws of the company and takes the rest of his income in dividends. Nancy Southern and her father, R.D., who ran ATCO, which has outperformed the market by a factor of 5 in the last 5, 10, 15, and 20 years, has a third-generation idiot heir proviso built in that the grandsons shall have worked outside the company for 5 years, that they will have a university degree, that they enter the company at a level of anybody else their age and experience, and that before they get an executive job, it'll be the independent members of the HR committee who make that determination. So if you take sort of the drag-along, tag-along coattails, which most of them have, and just say, what are the particular problems of dual-class shares and the potential for abuse, I think we're building up some examples, certainly in this country, of techniques that have been employed in boardrooms by boards and by the entrepreneurs that keep them in control of the company, but take away some of the potential for abuse hither and thither.
Well,
Yep.
I have a question for you, David. I think that the examples you gave provide some sort of protection. But what about when everything goes off the rails? So you've got a company that it goes, if you have a one share, one vote regime, or whatever you want to call it, there are ways to address that. There are not necessarily in, so I think you can look at one share, one vote as sort of a necessary insurance against that risk, because you can have a protection when things go wrong. You can't.
But then it's happened. It's not going to prevent it from going wrong.
No, prevent it, but there's a way that you can deal with what's gone off the rails.
Theoretically,
And I
but
see
don't
how
forget,
you
everybody
deal
in
with
this
that.
room is an agent themselves. They're not investors in these companies. They're not the individual investor. You invest on behalf of people, so you're agents of agents. There's a double agency cost here. And that is, I think, quite real. And so what do? BlackRock owns 7,000 publicly traded companies. Michelle Edkins is required to vote 100,000 proxies a year. How does BlackRock do that? She has a staff of 20, and that's twice the staff of the next largest. 45. But that's twice the size, maybe 3 times the size of the next largest staff who look after these things, 100,000 votes. So you outsource it to ISS or Glass Lewis. So is that going to protect us against a board that goes sour? It ends up being calculated by ISS in Bombay.
On that particular, BlackRock doesn't vote very closely with ISS, so I don't think you could, maybe it's outsourced, but it's not really to ISS.
Okay, but I just think there is an agency problem here. You are not kind of the individual mom and dad shareholders sitting at your kitchen sink and saying, you know what, the Bank of Montreal is really falling itself. Well, I'm going to go and talk to somebody and vote my 3 shares. So
part of how it's actually dealt with is a general preference a general proclivity to defer to management, except where you see problems.
I think that's right. But you don't see the problems if you don't know the company. And I would posit that you're better off trusting the board of directors, who are at least spending 250 hours a year on each company, and worrying about their election on the board than you would be having ISS decide for you which way you're going to vote.
Right, although I really am suspect of the boards of dual-class stock companies that are controlled by the CEO.
That is a problem, sometimes. Yeah, I agree. Next.
Well,
Why don't we move on to women on boards? How's that one doing?
Because that's not the topic, so we're trying to it's a better topic, but it's not the topic. So, David, do you see any parameters that will legitimately be placed on a dual-class structure?
No, I don't.
So you could have a multiple voting of 100 to 1, or you
Nothing.
could have no coattail?
No, I'm very much an advocate of what they call private ordering. That and I think I've got a quote here from Leo Strine, I think. One of America's, this is from Dana Friedman, the president of NASDAQ. One of America's greatest strengths is that we are a magnet for entrepreneurship and innovation. Central to cultivating this strength is establishing multiple paths that entrepreneurs can take to public markets. and that therefore it's a function of each individual company to add up and subtract and say, which way do I want to go? Do I want a sunset? Do I want a term sunset? Do I want an event sunset? Do I want this or that? That's called private ordering. And I think if you look at that diversity, through that lens of diversity, you come to a very different point than if you look at it through the lens of the shareholder. There's been a fight that's been going on since, I don't know, Michael Jensen, right? Agency costs were invented in 1986 or something?
Yeah.
Yeah, 86, the
Well,
Jensen
if you-
model. So, no, I don't
So if
see
you have
anything.
access to other people's money, let's say, the public markets, should there not be obligations that go along with that access?
By the management team? Yeah,
By
you
the
don't,
people- yes,
you
by
don't have
the-
to buy me. If you don't like Snapshot because there's no votes, don't buy it. It's called the Wall Street Walk. It's been there for a long time. I'm not obligating you to invest in the company I take public. I'm offering you an opportunity to participate in what I have established to date on the terms in which I'm going to take it public.
So
I have
is-
every right to have whatever terms I want. You have every right to decide to buy it or not.
What if it's an indexed company?
Ah, well, the indexes have already cut off. Two of them have cut off the dual class shares, right? FTSE and the Russell?
No, I mean, not exactly. The S&P 500, which is, has a lot of qualitative factors and related indices, no dual class.
Yeah.
FTSE Russell just says that you have to have at least 5% of votes
I see,
in the public
okay.
realm because votes are seen as part of the act.
But it is a good question, because what percent, Marcia, of private equities? No, but I'm just sort of thinking. No, but I want a fact. I want a fact. The fact of passive ETFs and mutual funds as a percentage of ownership of shares would be what, would you guess? 80% of the S&P 500?
No, that's
What would it be?
vastly exaggerated. So I was at a meeting in Harvard last fall where people argued about that for the whole afternoon. So
okay.
what that figure is, but it would be significantly less than that. I mean, but nevertheless, we see rising indexed assets.
But I could see
and-
the answer to Catherine's point being different if we were all sort of passive holders. So we didn't make individual buy-sell decisions. We couldn't do the Wall Street Walk because I bought the ETF. In that instance, I can see that maybe you're locking up value and, in your words, creating longer-term risk
And that's-
for that index.
And that's the majority, as you were just discussing. Of
I think it
investment
is,
now
but-
is the, yeah, it's the ETF. So you.
It's what?
You,
It's not 80%, okay.
I guess I'm stuck on the idea that you don't think that there should be any way of getting out, once you've bought your shares and the company, and you don't have a one share, one vote, there should be no recourse if the company.
Nope, I don't think shareholders know anything even close to what the board knows, so.
So what
they're-
would you do, what would you recommend to Bombardier shareholders then?
They should have sold last year.
They should have sold.
I read the press. I can tell you, that company, any sentient person reading the business press can see that stuff. You could see that they lost their
So the problem
engineering.
is with non-sentient
They lost their
shareholders.
engineering capabilities 2 decades ago. What would you do with Boeing? Now, Boeing, widely held, independent board of directors, build a plane that kills 350 people, and you now are getting the emails that say this plane was designed by monkeys and overseen by idiots from the engineering staff on the floor, and the board never saw it. What about Wells Fargo? There's a great example. 10 years, he systematically defrauded his customer base, and not a single director knew it. That's great. One share, one vote, all you guys owning it.
But there are other
Brilliant
issues.
work.
Both-
Brilliant work, Ken. I'm thrilled.
But there are other issues. In both of those cases, I'd actually, you can't go to one source, but I think the combined share CEO actually was a problem both at Wells Fargo and Boeing.
There you go. Well, have you changed that one yet?
So they have it, those two companies. You're changing it too late.
That's true. No, that's right.
So if I can ask you.
Oh, by the way, listen, another piece on the Wells Fargo. The board itself didn't fire Stumpf. It was Warren Buffett, the shareholder, who phoned the lead director and said, "You've got to get this man out of here." The board didn't even take action then. I was, terrible. These one vote, one person boards are just awful. Hate
So
'em.
do you think that there should be any special governance principles in place for dual-class company, anything to protect minority shareholders?
Well, we started the coalition, as Steve will attest, saying that best practices are probably things that we should promulgate. So we split chairs and CEOs at the banks early on, put that forward as a best practice, and it was adopted in a lot of other Canadian companies. I think if you took things like what ATCO has done with the Southern family and succession to prevent the idiot heir, what Prem Watts has done at Fairfax to prevent abuse of salary, and put them forward as best practices in a much more variegated way than simply ideologically being opposed to these things.
So not
We might in Canada, and it might not happen in the States. Ken and I had this discussion earlier. I think there's a lot more social mobility of ideas in this country than there is in the States. So when we took the banks and asked them to split chairs and CEOs, they did. 5 banks, 15 directors each, 75 directors. They were all on 2 other boards. That's, that's 200 different companies, and they all migrated pretty much immediately. I don't think that social transmission of best practices happens nearly as much in the States, but I think we could do it here.
Well, that is true, but theoretically, you could vote those boards off that we're not making that adaptation, right? You can't
Yeah.
do that. You can't do that with dual-class companies.
Well, you could
that are
castigate them.
You can castigate them.
Well, we do. We do have that here. We have the carrot and the whip. The carrot being best practices that you put out 18, 19 years, and the whip is our board games where we measure them all.
What's the whip for dual-class share companies?
Well, we're creating one at the moment.
Okay.
I hope.
But I think that is
With your kind donations, Marcia.
I think that is the issue. We're setting up long-term structures that are very difficult to change down the line, and we've seen some dual-class companies change, but it takes an extraordinary effort, extraordinary demonstration of failure, really, to get them to do that. Now there are some where the family recognizes their weaknesses. Estee Lauder's dual class, William Lauder, succeeded to be CEO. I don't think he entered the company at a particularly low rank. But he at some point took a view that I'm not the best person to be the CEO of this company. And so he moved into the chair role. They hired a non-family CEO and the stock took off.
Yeah.
So there are some people who see that, but I think that can be the exception.
Yeah.
And I guess the question is whether the public markets want to wait for that exception, or whether they want to have some sort of rights to exercise to make that happen, or some sort of regulation that can be appealed to.
I'm very much, I see everything through the notion of private ordering. What we need to do as an economy and as a society is get as many of these companies public that wish to go public on terms they wish to have, and that we're all going to be better off that way. And there's abuse on single shares, and there's abuse on multiple shares, and it's 6 of one, half a dozen of the other.
Except that there's action you can take on one.
Well, accepting that the center of gravity of the world's economy has moved into private equity. By the way, good news. Did I tell you this today? Toronto had 2 times as many high-tech jobs created in 2019 than any other city in North America. This place is alive with entrepreneurial activity, with VCs and private equity. It's incredible. I'm sort of saying that avalanche, if they choose to go public, let them go public on the terms they want. If they choose to stay private, and you're getting 2 times as much money, that's one thing that happened is, as chairman of this company, I was offered 7 times EBITDA in the public marketplace with all these other costs attendant to it, and I was offered 15 times EBITDA in the private equity marketplace with none of these other costs. So that's where the world is at the moment, and that's what's exploding with activity, and I wouldn't inhibit anybody from going into the public markets if they wish to do so, nor would I encumber them in any way, shape, or form.
So I would say more fundamentally, we are dedicated to encumbering public companies with certain obligations to a dispersed shareholder base because they can't have the same information that private company owners have. So we favor quite a number of disclosure rules around public companies. I see nothing wrong with making the equation between staying private and going public.
Yeah.
But you do have obligations to dispersed share owners that I think are quite an important aspect of public markets. That's just.
Well, the SEC's been precluded from doing anything about that because it's states' rights.
Well, yes and no. I mean, on the disclosure front, the SEC rules play a huge role.
Yeah. But on the prevention of dual-class shares, they play no role. So they're going to happen anyhow.
Why do you think companies continue to go public then?
For
Just
liquidity,
liquidity.
you take a company like Geotab now, which is is still private, will probably stay private forever. It has more telemetry and trucks than any other company in the world. It's a spectacular success. They now have people in there who've been working there for 16 years who might want to go do something else, who have been shareholders. There is no market for those shares. So if Neil Cause takes Geotab public, it'll give an exit potential for those of his employees who wish to diversify their assets or get out of the assets or change their employment. Gives him an M&A currency if he wishes to acquire anybody else. And maybe perhaps a little public prestige. I mean, this man has built an incredible company here in Mississauga. Amazing. So those are other reasons he might go public. But my strong advice to him is even if you don't own more than 30%, he happens to, but I'd go public with dual-class shares. I don't want pesky little 26-year-old MBA graduates from my school phoning you up with a better idea about how you can run this company, period. Okay? Any other questions, Ken?
Well, you go ahead.
Well, I think it's true. We have much more asset-light companies now, so so for a lot of companies, it's liquidity that's important. There are still companies that need capital that are going to public markets because of the scale of the capital they need, and we're not totally post-capital society yet.
Yeah, I'd agree with that. Got to be some questions out
Sorry,
there.
yeah, I think.
I don't know. When
Yes,
I got a
now it's
question.
time
When
for
can we have a
questions.
drink? That's my question.
Okay.
I did have one question. It goes to a little bit of your point on if the company is dual class, there should be some kind of best practices at a minimum. And this goes to a dual class company's incentive to actually meet with a shareholder with a significant holding. And, we've run into this from time to time as the coalition, where certain dual-class companies will refuse to meet with us, even though our membership owns quite a significant percentage of their company. But they don't need to. They don't need to meet with us. There's no incentive. So this goes a little bit to your comment around how do you hold a dual-class company accountable to say, these are still your shareholders, and you need to you need to pay some attention to them and meet with them if they've got a significant holding.
What do I think they know? Why would I take my time as chairman of the board of a publicly traded dual-class share company to talk to somebody who owns 8,000 different companies and knows absolutely nothing about the dynamics of our market? Don't even know the names of my employees, let alone our 5 biggest customers. Why would I take that time?
Because you've taken their money.
No, they've chosen to invest their money
and
in
you have
me.
chosen to take
I
that
didn't
money,
take
take
it. Sorry, you bought it. I didn't. Nope. Why would I?
That's just okay.
Claude Lamoureux said, this is, I guess, in a cone of silence in a way, but I asked Claude about this. About all of their private equity work, because teachers started this a long time ago. And I said, who do you put on your boards when you have a private equity? He said, I'd never trust my analysts. They're brilliant analysts. They make great investment decisions, but they never run anything. So I always get independent directors who can put their feet in there and understand what's happening. I'd never let a board of directors of any private equity company we are involved in be run only by my analysts. They are so far from the data, so far from the information, and they've never run a damn thing. So what do they know about running a company? So why would I have a chat with them?
That's interesting coming from somebody
Yeah.
who was the executive director of the coalition who sought to meet with public companies. But
I don't think.
Anyway,
No, we split chairs and CEO, right, Ken? Yeah.
okay, I'm going to turn it over to the audience. Does anybody have a question or a comment? Yes. Yeah, here. I'm going to give you my mic.
Sorry. Not reacting fast enough.
You made a real good argument about the principal agent problem and advantage of private equity versus public equity, because obviously with carried interest and things like it, it's less of this conflict. But how exactly would dual shares protect the board that is any case too cozy with the management? And typically, if you look at any of these disasters like Enron, the board was not asking questions, the board was too close to management, because generally speaking, and the only people they hear is sometimes activists, like you say, Warren Buffett call. So if people have at least some rights, they're not exercising them, they have agency problems, they have everything, but there is at least a chance they can remind board about something. Otherwise, there is board and management, nice sort of friendly atmosphere. and the shareholders are completely cut off. This is different from private equity, and I understand your argument about private equity. It is great. But what additional protection to anybody dual class shares given there?
So what additional protection does dual class provide? Or
Yes, but it's written agency problem. So private equity is different because then there is less of this problem. The directors are more hands-on, all the stuff like that.
right.
If you have equal one vote, one share, and you can look at activism in any way, as negative as positive, but in a lot of the scandals, there was an activist investor who was generating the money, like Warren Buffett case of Fargo. So there is at least somebody who have some right and can allot the board, and the board have to listen. If you make it more the shift, and you are saying you have less rights, then you have board that is already very close to management in all these cases, and they will be even closer.
Yeah, so that's my concern. I look at the Facebook board, and I don't see a board that's going to challenge the CEO, the chairman CEO, Zuckerberg. It's just not going to happen. And it's very clear that he's signing off on who's on the board. He has 60% of voting rights. And I think people do need challenges. It is, I guess, distracting. But I think people get caught into their little narrow vision, and they need correction. So that's a fundamental problem.
Yeah, no, I don't disagree that some entrepreneurs begin to think that they're the second coming of the Lord.
Some?
Well, the challenge is none of us know what happens when the boardroom door closes. We really only influence inputs. So we've been talking about expertise. We got it with SOX on the audit committee. We got it with Dodd-Frank. We got it with on financial services industry, having somebody who's been in the risk management arena of that directly. And that notion, I think, has been promulgated very effectively by the coalition and probably by the CII. You need people on boards who have some knowledge of the company and some of the company's operations, not just gifted amateurs. We do that. We worry about diversity, not only gender diversity, but thought diversity in the board. These are all inputs that we do worry about as investors. But when that door closes, you have no idea of the social dynamics that are going on inside that room. We're just all blinded to it. And obviously, some of those boardroom doors are closed. In the case of Wells Fargo or Boeing, they don't hear anything outside of their own voices. So
certainly that can be true at one share, one vote companies. But
yeah.
I think you can look at some of the dual class boards where the controlling shareholder is the CEO, and you have a pretty good idea. These people are not likely to be challenging the CEO.
Like the U.S. Congress.
Well, that's true. Yeah, but that's why. Fundamentally, my problem is with a long-termism issue, that we're creating structures that are very difficult to unwind. And that's why there should be some reality check at some point in time on the structure. I think that if it's a convincing structure for shareholders, as I think would have been the case in Google in 2011, as I mentioned, I think they'll support it. But there needs to be a reality check eventually, and not just with the death of the founder.
Yeah, and a compulsory one, not the one that you were describing with the Southern family. It's nice, it's all very well and good, but that's a voluntary.
But it is a best practice, and I think there's a role for promulgating best practices the same way we did 15 years ago with splitting the chair and CEO and other things. I think we've made a difference positively in terms of the overall governance of publicly traded companies in this country.
Definitely.
And I wouldn't want to abandon the dual class share challenges to an ideological no. We don't like them, go away. Well, they're here, and they're not going away. So maybe we should invest a little bit more time in trying to figure out who is getting around the particular problems more effectively, so I don't have to worry about that cost, potentially.
But you would not look to sunset provisions as being the answer to all of our issues here? No.
But that's just being cantankerous.
Like renewable, oh, okay. Are there any other questions? Anybody have any? No? Would you? Oh, okay, thank you.
Thanks. You mentioned Prem Watsa as an example of where this may work. So I'm interested in both your comments around how you may look at balancing compensation for management in these situations where you do have dual class share structures. Would you look at it differently? Would you see it as a way to improve alignment, given that we don't know what's going on in the boardroom?
Yeah, I don't know. I think we've created our own monster here by trying to align managers to long-term shareholder returns by giving them options. They now last 5 years. Any CEO of any publicly traded company is going to be looking at his own asset base and saying, if I can get this share moving up 15% a year for the 5 years I'm likely to be here as a CEO, I'll walk away with $250 million. So year 3, he's got a share forecast of $215. He knows a month in advance that he's going to come in at $212. How does he find that 3 cents? He raised the advertising budget, the marketing budget, the IT budget. No director in the world will ever see that. And so we've incentivized management to, I think, short-term kind of performance. They got 5 years to be at the helm of this company. They'd love to walk away with $100 million. They're given a zillion options in order to increase the share price. What do you think they're going to do? I don't think that's any different in the single share as it is in the dual class.
Yeah, so there is some evidence actually that CEO pay is overall higher at dual class stock companies. There's a variety of patterns. The IRRC Institute had done a study, 2 studies actually, suggesting that there's a bigger disconnect overall. And I can certainly cite counterexamples.
Yeah.
I talked to the CEO of Telephone and Data Systems some years ago. It's a family control company, a Carlson family. And back in the 90s, there were no requirements about size or independence of a comp committee. So, or at least at a control company. I don't think there were any at all. So they had a 1-member comp committee, which I never could get my head around. Like, the 1-member committee met. They have to report how many times they met in a year. How does that work? But anyway, but it was his sister, which doesn't look good. But he pointed out his pay was actually quite low, which is true. It was quite low.
Well, so was Michael Eisner, and the chairman of his comp committee was his personal lawyer. So they only paid himself $78 million a year. I thought that was quite reasonable, wasn't it? Yeah.
Well,
widely held, one share, one vote. Yeah.
Carlson was paid much less than his peers, actually. So his sister was tight-fisted.
So we're coming to the end here, and I wanted to ask if you had any summation comments you'd like to make, or that's it?
Well,
I
so
felt like you made your point.
Yeah, So as I indicated, I think that we have a lot of members who just oppose dual-class stock, period. Personally, I'm not that concerned in the short term because I do think that markets can price it in, but I think we create problems longer term. Oh, and I didn't say, we're running an experiment that really only started in 2004 with the Google-type tech dual-class structure. And there are various studies out there on effects. I don't think we actually know yet. I think it's actually kind of early in the run for these things. And the studies are in different size. But I think we're running an experiment that if it ends badly, that's potentially a really big problem, and we just don't know.
Yeah, well, maybe all publicly traded companies that are single-class shares will disappear. The trend continues from 25 years ago. We're going to be down to 1,000 publicly traded companies in the States by 2025, and then maybe 0 by 2030, and it'll all go private equity dual-class shares.
No, we'll be down to 1.
Okay.
One Amazon, maybe?
I don't.
I think it's an antitrust.
Maybe that's true. Yeah, it would own everything. That's probably right. I just say in Canada, we did a study at my center on dual-class shares and family-controlled companies through their second generation. There were 23 of them, all publicly listed, all dual-class shares, all family-controlled, and they outperformed the rest of the market by significant amounts over 5, 10, and 15 years. So the evidence in this...
Second generation or third generation?
It was into the third generation.
Into the third generation.
So the evidence here in this nation, and maybe it reflects differently on our society, because, I mean, other societies have different dual-class. I think Denmark is 87% or something, huge. In this country, in this society, dual-class shares of family-held companies in their third generation significantly outperformed everybody else. Now, all kinds of reasons for that, but it's an interesting data point in terms of dual-class shares not being all evil to all men and women at all times.
Again, I say that the Silicon Valley tech model dual-class is, I think, quite different from the family control companies. It's a different creature, and I don't think we really know yet.
Okay. So I think they're there. My bottom line is they're there. They're not going away, and you better get used to them.
Good,
and the
okay.
more work we can do in terms of promulgating best practices, I think the better off we're going to be. We won't be worse off. Thank you.
Have a pithy statement you wanted to?
Well, best practice. I'm not opposing best practices.
Okay.
I think that's great work.
Please welcome me or join me in thanking our panelists. That was very interesting. Great. Thank you very much.